All right, good morning, everyone. Thank you for tuning into today's webinar, The Future of Sustainable Investing, Reducing Your Carbon Footprint While Growing Your Portfolio, in partnership with Patrick Costello of Green River Sustainable Financial Planning. My name is Natasha. I am the marketing manager here at Marin Magazine of Make It Better Media Group, and I will be the woman behind the curtains helping to moderate today's webinar. We have a great presentation for you with a panel of key players in the sustainable investment industry. We are also joined by Aaron Gray of Green Century Funds, Emily Lee from Impacts World Funds, and Andy Behar from the nonprofit As You Sow. I am accompanied by Susan Noyes, the founder and the publisher of Make It Better Media Group. Susan brings with her decades of experience navigating the financial world and has a great passion for creating social impact and a more sustainable future with her investments. Susan will be leading our panel discussion and will say a few words of gratitude and welcome before I introduce Patrick.
Thank you so much, Natasha. You said that perfectly. I am here to say thank you to everyone who's joining us. It is so important to talk about how to use our money to create greater social impact and a more sustainable future. This is more important than ever. And we are so very grateful to be doing this in partnership with Patrick and this group. So welcome and thank you.
Thanks, Susan. Alrighty, Patrick is a certified financial planner, professional, and the founder of Green River Sustainable Financial Planning, an investment firm in Marin County serving individuals throughout California who wish to divest from fossil fuels and lower the carbon footprint of their investments. He is also author of the book Low Carbon Investing, Defending the Climate and Emphasizing Performance, published in 2018. His nonprofit work includes leading the fossil fuel divest invest team for 350marin.org and serving on the board of Fossil Free California, an East Bay organization that works with the trustees of the two gargantuan California pension plans, CalSTRS and CalPERS, urging them to divest from coal, oil, and gas stocks to improve investment performance and preserve a livable climate for our children. So without further delay, I am going to pull up today's slideshow, and Patrick, you can take it away.
All righty. Thank you, Natasha. Thank you, Susan. And thank you, Marin Magazine, for providing us with this webinar platform, helping us engage our community. Welcome, folks. You know, in the history books, the chapter on 2020 will be as thick as would normally be used for a decade, right? Next. At Green River, we design low carbon investment strategies for clients within the context of their financial plan. Next. This is our contact information, and we will remind you again later. Next. Next, please. Okay, perfect. Words to the wise. You know, these are just a few pointers that all investors should be aware of. Next, please. You know, let's take a moment. Let's take a moment to acknowledge the resilience so many of us have had to show. You know, it's not as if we've had a choice. The heroism of frontline workers, firefighters, and then let's just extend our compassion and empathy for all the suffering so many people have endured and are continuing to endure around the world during this crazy year of 2020. You know, with 2020 as the backdrop, personal investing strategies may seem to diminish in importance, but I'd like to make the opposite case. We are in fact hurtling toward climate chaos faster than scientists projected just a few years ago. Shrinking our carbon footprints is ever more important, and personal investing is one place where we can really make an impact. I'm a certified financial planner, and Green River is a company I started about a decade ago. One of my goals was to have a company culture unlike what you'd find at traditional organizations. They don't call finance the dreary science for nothing. We don't dress in suits and ties. We're fun and irreverent. We work to build a warm human relationship with our clients. We talk about everything: music, sports, art, literature, politics, while we help you reach your financial goals. Another objective I've had is to demystify investing. It's not as complicated as it seems. The hard part is unlearning some things the industry has worked hard to make us believe. Next. The world is rapidly shifting to a low carbon economy. 2020 has been by far the year with the greatest divergence between the performance of coal, oil, and gas stocks collectively called fossil fuels, and the performance of renewable energy companies that deliver solar and wind power. Exxon, truly the poster child for climate destruction, has lost about 50% of its value just this year, while many solar and wind companies and the funds that own them are up 40 to 50%. This has been a tremendous change in financial markets. And as you can see, Exxon is still acting as if the 2016 Paris Climate Accords to reduce emissions never happened. Next. I think you'll agree it's time to exchange our formerly big oily footprints for smaller, svelte, green ones. Next. This is a very important slide. People underestimate the impact of decarbonizing their investments. Next. We can say low carbon investing is a subset of sustainable ESG investing, and we will clarify the distinctions later. This diagram illustrates how sustainable investors hunt for companies that have two qualities: strong investment potential and high ESG scores. Next. ESG is a way to evaluate the sustainability of a company by looking at how it treats the environment, what its social impact is on its human capital, its employees, and then also how it governs itself. Next. The growth of sustainable investing has been phenomenal. This is from a report that literally ended at the beginning of 2018. So here we are 2.5 years later, a new report is on its way. And our guess is that now the way the ratios look is that 1 in 2 or even 1 in 3 or 1 in 2 of every dollar invested in the US is under the rubric or the umbrella categorization of sustainable investing, socially responsible investing, or ESG investing. It's truly an amazing increase. Next. Point of clarification. We use funds, baskets of stocks and bonds when we build portfolios for our clients. Fund managers select the individual companies that they hold, and we will introduce you to representatives from 2 of our favorite fund families momentarily. Next. Here's an analogy that may help you understand why holding on to fossil fuel-laden funds managed by the old guard, and by the old guard, I mean the companies Vanguard, Fidelity, American Funds, and BlackRock's iShares. Holding those funds, the broad-based large cap stock funds that those companies offer, truly means diminished performance. Those of us who have been around for a while remember when the big 3 Detroit automobile companies got their proverbial lunch eaten by Japanese upstarts, Toyota, Honda, etc. Chevy, Ford, and Chrysler had grown complacent, bogged down by institutional inertia, blind to the fact that consumers were looking for different things, that other nimble, ambitious upstarts were only too willing to provide. The same thing is happening in the investment world. The young, ambitious upstart fund families are leading the charge to a low carbon, green, sustainable future, and the performance of their funds reflect their wisdom and perspicacity. These forward-thinking fund families challenging the big 4 are my partners. They are the reason we are able to design high-performance, low-carbon, sustainable portfolios for our clients. Our other essential partners are organizations who have created online tools that allow us to quickly evaluate a fund. How much fossil fuel exposure does it have? Is there a healthy gender balance in leadership roles inside the companies held by that fund? One of these data providers is asyousow.org, and we will hear from CEO Andrew Behar later in this presentation. While there's no question that working with Green River is a fabulous experience, we will spend most of the rest of this presentation talking about our partners, 2 of our most valued fund families and our go-to data provider. So without further ado, please let me turn it over to Erin Gray from the Green Century Fund family. Next. There it is.
Great, thank you so much, Patrick, and it's a pleasure to be here with everyone today. So I'll start off with just a little bit of background about Green Century Funds. We are the first family of broadly diversified, responsibly screened, and fossil fuel-free mutual funds in the country. And our whole mission is to provide positive environmental impact. And we do that in three main ways. The first is through investing in sustainable companies. You'll see in the bottom right-hand box there, we offer 3 mutual fund portfolios that are sustainably and responsibly screened. The first is an international fund, which invests in companies outside of the US. And this is potentially a great way to diversify a portfolio. We also invest in an equity fund, which tracks US companies and which invests in US companies and tracks the longest running sustainable investment index. And we also offer a balance fund, which invests in both stocks and bonds. The second part of our strategy is a shareholder advocacy program, and this is where we work with companies to improve their environmental performance. And third, we have a unique ownership structure. We were founded by environmental and public health advocacy organizations nearly 30 years ago, back in 1991. And these are state-based groups, and you might be familiar with the California Public Interest Research Group, or CalPIRG, or Environment California, which are some of our local affiliates. So I'll just move on to describing how portfolio managers select companies to invest in. So as Patrick mentioned, our research analysts do a deep dive on E, S, and G research at least once a year. And then they figure out what are the most material or significant ESG factors for each industry and compare peer-to-peer companies within that industry. So for example, for a manufacturing company, you'd want to look at the company's environmental footprint and carbon emissions. But for a financial services company, you would want to look more at what are their lending policies and practices. That's where they have more of an impact, and where are they directing capital. We also screen out companies that we feel are detrimental to society. So things like weapons manufacturers, tobacco, GMO producers, and nuclear energy and power. And then lastly, having an environmental focus, we also don't invest in fossil fuels or traditional energy companies. These are the companies that we feel are most responsible for the majority of carbon emissions. So there's several reasons why you might want to invest fossil fuel free. So as Patrick mentioned, there are significant potential financial risks, and we'll talk about performance in a minute. Divestment also allows a portfolio to be more aligned with an investor's values, especially if you care about environmental issues. The fossil fuel industry has had a tremendous impact on politics and national policy, like regulation and subsidies. So this is a way to break that power chain. And then lastly, it frees up investment capital for cleaner and more renewable, sustainable companies. As I mentioned performance, the next slide we'll see a graph here. The yellow line shows an international investment index, and that blue line is that same portfolio except without fossil fuel companies. And that's actually, the blue line is the index that our Green Century International Fund tracks. The fossil fuel sector has been the worst performing sector over the last year and the last decade, and you can see how it's playing out in performance here. So I'll share a few examples of types of companies that you might find in a sustainably and responsibly screened portfolio. So Vestas is a Danish wind company. They're responsible for 18% of global wind power. Xylem is a water technology and water efficiency company. They work on filtration systems. For example, they're working on the new Beijing airport runoff systems into gray water and creating, making sure there's no leaks, as well as creating efficient heat pump systems. And then the last example there, Starbucks, this is actually a sustainability bond. And over half of our fixed income portfolio in our balance fund invests in green and sustainability bonds like this. In the Starbucks example, the proceeds from this security will help farmers increase their soil quality, as well as protect local wildlife by using more shade-grown trees in the coffee plantations. So moving on to shareholder advocacy. As investors, we have many tools that we can use to engage with a company to improve their environmental, social, or governance performance. We can simply start with a dialogue, reaching out to the company and sharing our concerns. If the company is able to make progress, that's great. If not, we can then go on and file a shareholder resolution, which is an item that gets put on the proxy ballot for all of the company's shareholders to vote on. And then with our larger portfolios, we vote on those proxies of all of the companies in our portfolios as well. We can also work at a policy level, trying to raise the ESG standards for a whole industry. And we work in coalition with other like-minded investors, as well as issue experts on areas like animal welfare and sustainable agriculture. So I'll just do a quick example of an engagement we did. And the issue or area of concern we have is how to protect pollinators. So pollinated crops are over 1/3 of the food crops grown in the world. It's a huge part of our economy, but some of these toxic chemicals have contributed to a significant global decrease of honeybees, insects, butterflies, and pollinators. These chemicals also have an adverse medical impact for people, causing cancer, links to reproductive, immune, and nervous system issues for farmers and children. And so as part of the solution, Green Century and other investors work to develop quantitative time-bound goals for these companies to improve their behavior. So as an example, we have a timeline showing our engagement on this issue with General Mills, and we partnered with Andy and As You Sow's group. So both in 2018 and 2019, we started a dialogue with the company. We weren't able to make significant progress on change on this issue of protecting pollinators, so we filed a shareholder resolution each year. In 2018, over nearly 1/3 of shareholders supported this resolution. And in 2019, we were actually able to get the company to change, and we're able to withdraw this resolution, not only from investor concern, but also you'll see in October of 2018, there started to be news and press around one of these toxic chemicals being found in Cheerios. So moving on, there were key elements to this engagement that helped make progress. First of all, General Mills has several brand name products. So they do face reputational risk, especially to Cheerios, one of these flagship type brands. And we were able to make the business case that they can reduce risk by increasing food security and safeguarding ecosystems, biodiversity, and public health with these changes. And the company committed to increasing their regenerative agriculture program to cover at least 1 million acres. They'll increase crop variety. They will show concrete goals by the end of the first year. And then they'll do this not only with regenerative agriculture, but also their integrated pest management program. So this is an example. We have 3 full-time shareholder advocates who simply work with companies on these issues. You'll see we work on a variety of environmental issues, from protecting tropical forests to preserving animal welfare, trying to get antibiotics out of the food supply, and increasing the use of renewable energy. And then I'll just wrap up with an example. So investors in Green Century not only get this type of engagement on a corporate level, but also from our nonprofit owners and the campaigns and engagements that they run. So one example of a campaign is called 100% Renewable Energy. And here in California, we were able to work with the state to pass State Bill 100, which commits California to 100% renewable and zero carbon energy by 2045. So California is now one of 6 states to make this commitment, and the campaign is targeting an additional 8 states. So this is a way to make environmental progress at the state and local level, especially in our current environment, when we are, playing defense and really trying to stop environmental rollbacks at the national level. And I think that's partly why this MIT publication called it the most important climate law in US history. And with that, we'll hear more from Andy, and there's several tools that investors have to be able to look at your current portfolio, and then you can work with advisors like Patrick on how can you kind of move this, get away from some of these industries or companies you might not want to be invested in, and how can you reinvest in cleaner and more sustainable companies. And with that, I'll turn it back.
Great. I think it's my turn next. Thanks, Erin. Thanks, Patrick. Thanks, everyone, for being here with us. We're really excited to be here. My name's Emily Lee, and I work for Impacts and Pax World Funds. Always excited to get to talk to people. I'm also based here in California, just over the bridge from Marin in San Francisco. So I hope everyone's been doing well during these crazy past few months that we've had. I think Erin did an awesome job talking about the basics around ESG, around the importance of divestment. So I wanted to focus my time thinking about the reinvestment, right? What do you do once you've made that decision? How do you find areas to invest where you'll have the most impact from an environmental or societal viewpoint? So I'm going to talk a little bit about our firm and how we view this investment opportunity as well. So this here is our investment philosophy, and it's important to understand how we work as an investment manager, how we create sustainable funds that folks like Patrick uses for his clients. So at Impacts, we're a specialist asset manager, and we're focused on investing in the opportunities that arise from a transition to a more global economy. We really feel at our firm that capital markets are undergoing and have been undergoing a transition that's going to continue to be shaped by global sustainability challenges that we face, some of which Erin talked about: climate change, pollution, necessary investments in human capital management, infrastructure, resource scarcity. All these trends are going to be driving growth opportunities for some companies, but they're also going to be providing risks for those companies and those industries that are unwilling or unable to adapt to this transition. So at Impacts, we take this viewpoint of identifying where the growth opportunities are going to be, interpreting the nuances of this data, and investing our portfolios accordingly. So on the next slide, I won't spend too much time here, but this is a little bit of information about Pax World Funds. And I think it's important to note that from day one, all that we've done has been focused on ESG and sustainable investing. And for us, day one meant 1971. So we've been at it for a while, as has Green Century. So again, really proud to be a partner of folks like Patrick, because he knows that our firm has deep expertise and experience in this ever-evolving space. And we've got 11 different funds that we offer across the board that Patrick can share more about. One other thing to note on this slide, because I'll touch on this later, is at our firm, you know, E, S, and G focuses on a lot of areas, right? And I think we've talked about the environmental part a bunch, and we want to talk about the social and governance aspects as well. So one area that we really see as a human rights issue for us at Pax is gender equality. So we launched the first gender equality focused mutual fund back in 2007, and I'll certainly talk about that more a little bit later. On the next slide, I wanted to share a little bit more of a visual on this concept of us in transition, because I think it helps put things in perspective. So like I said, we really feel like we've been in a depletive economic model where environmental, social consequences have been ignored. So we really feel like for too long, capital has been invested in this short-sighted way without considering social and environmental impacts. And I think what we've been going through this past year has helped really increase the speed of this transition. And you see also listed here some of the other disruptors that sort of are driving this transition to the more sustainable economic model, where externalities are not ignored, where we consider social and environmental impacts. Those are things like technology, preferences from folks like you, social factors, regulation, et cetera. So we really feel like we are at this inflection point where the speed to this transition has even increased this past year alone. And so with this transition, for lack of a better word, there's going to be companies that come out of this as winners and those that come out of this as losers. So it's our job to really interpret these risks and opportunities and invest our portfolios accordingly. So I think Erin shared some great examples of companies that Green Century invests in. These are a couple of examples of how we identify sort of sustainability mega trends, if you will, and kind of what are these areas that are headed towards a more sustainable solution. So I'll just share a couple of examples. One, if you stay on that slide. So clean energy, we really obviously know that we're in this transition from the traditional combustible engine to electronic vehicles. Just recently, California announced that by, I think it's 2035, which sometimes sounds so far away, but by 2035, they'll no longer sell gas cars, right? So if you're thinking of where to put your money in terms of, yes, your values, your environmental benefit, but also sort of where the growth is going, where the industry is heading, you want to look to the EV market. So one way we do that is rather than investing in the automobile manufacturers, we invest in a company called Aptiv. And Aptiv is actually a technology software company that is transitioning their business to focus on making cars safer for drivers, making cars greener, and really moving us towards that environmental aspect of EV vehicle movement. Another area that Erin teed up really well, and something obviously in California is a huge topic, is agriculture, right? Moving us towards a more sustainable agricultural framework where we think about soil health, we think about water usage, we think about pesticides and things like Erin talked about. So one way that we do that in our portfolios is we have a company called Trimble, and Trimble is a technology company that basically uses GPS technology to work with sustainable agriculture farmers to develop methods and GPS information as to when they should water their fields, the timing, the amount of water. So again, thinking of doing that same work, how to feed our population, but do so in a way that considers those environmental and social factors. A third one, another that I think has really, been increased in all our minds during the pandemic is healthcare, right? And so this movement about thinking about how we can have better personalized medical care, to have better patient outcomes, to have better management of healthcare data. And so one company we invest in is called IQVIA. And IQVIA is a leading global firm that uses technology, that uses software, basically all about improving human health and improving patient outcomes. So those are just three examples of kind of how we invest in the winners, if you will, how we use that transition idea to identify the high opportunity areas. On the next slide, I know this is a little bit hard to read with all these symbols, but I wanted to just touch on sort of how we do it, because some of you might be thinking, how do we identify all these areas when we're thinking about where to invest our mutual funds? So we developed a tool at Impacts called the Impacts Lens, and this tool was developed from our London team. So it's based off of a team of portfolio managers, analysts, public policy experts. We have a climate scientist on staff in London. So what they do is they look across the whole market. They look at all the sectors, all the subsectors, and they say, where do we feel like going forward there's areas that it's going to be areas of high opportunity, so things that think about resource efficiency, things that think about climate change, healthcare, and where are there going to be industries or areas of high risk, right? Fossil fuels being a big one of them. So the idea is that this helps our portfolio managers then look at the universe of companies and use not just our ESG scoring, but think about, wait, is this really a high opportunity, low risk area, or is this a high risk, low opportunity? And we sort of try to tailor our portfolios accordingly. So that's just one tool that we use that I wanted to share. So on the next slide, we're sort of switching gears here. I don't know the best transition, but we talked about ESG and we focused on climate a lot, but I wanted to touch on our focus on gender at our firm. So we launched the PAX Elevate Global Women's Leadership Fund years ago. It's really one of the first funds that invests in gender leadership. So you might hear the term, and I might have already said the term, gender lens investing. What this means is basically you're thinking about, how do I invest my portfolio in a way that supports gender leadership? So we came up with the idea, and then we had to decide, all right, how do we create an investment vehicle around this? So if you look to the next slide, I won't spend too much time here. Patrick is very familiar with this fund, but we've had a long track record, long performance with the fund. And on the next slide, just as a reminder for anyone that might be thinking, why would this make sense from a financial impact standpoint? There's so much data and so much research behind the importance of gender diversity at companies when you think about their risk and you think about their performance. So I know we've all seen, obviously, things in the media where a company might have a sexual harassment scandal or they might have lawsuits. And you can really look back and see that things like that not only affect a company's stock price immediately after the news comes out, but there's a dramatic decline in the stock price over the next 2 years on average. So these issues around gender aren't just a nice thing for companies to do. They're really important to a company's reputation, to a company's long-term performance. When you think about, turnover of employees, it costs an average of 33% of an annual salary to replace an employee. So if you have a culture where perhaps you're hiring a more diverse workforce, but you're not supporting them in the work environment and the culture of the firm, you're going to have turnover. So a lot of financial issues are related to this lack of taking this issue seriously from a company standpoint. On the next slide, we could spend the whole presentation talking about all the research that goes on behind this, and there's a lot that we put on our website. Just know that there's so much research out there that really points to if a company has more diversity, especially on the board level, they're going to outperform and at less risk with their neighbors. So I know I'm coming up on time, so let me switch to the next couple of slides. So the next slide, what we did is we had to create our own index because this was a new thing. So we took the MSCI World Index. We rated all the companies based on our proprietary gender score, which you can see on the visual there, contains things like number of women on the board, number of women in senior management. Does the company do anything around gender pay equity, which is a huge issue? What kind of transparency and policies do they have in place? We take our ESG factors into consideration. We take out fossil fuels. So on the next slide, we then, from that step, create the mutual fund where we have 400 companies that are the best companies in the world for advancing gender leadership in the workplace. And we're really proud of the work that we've done. I'll end with the next slide, which is just really, Aaron teed it up very well. At our firm, we also don't want to stop at just saying, all right, here's the research that we did, here's the fund you can invest in. We want to use these conversations we're having with companies. We want to use the tools Aaron talked about around proxy voting, shareholder proposals, and we want to call out companies and push them to do better when it comes to these areas. So we do a lot of work, and Patrick can share some specific stories around women on boards, around looking at diversity beyond just gender, and we're doing a lot of work right now with companies on pay equity as well. So with that, I will stop there. Thank you again, and I'll turn it back to Patrick.
Thank you so much, Aaron and Emily. And before we move on, I wanted to say a few words myself about the gender lens investing. One of the, that Emily just gave us a lot of important information about. The simple translation is that we now have solid data showing that companies with diverse gender balanced management teams simply make better corporate decisions, leading to better stock performance. I mean, that's how simple it is. But there's the deeper value as well. Women in corporate leadership tend to have a strong focus on supporting their employees, especially women and families, with important benefits such as paid maternal leave and high quality health care. How does this impact emissions, you might wonder? Well, when women enjoy a good education and are able to move into satisfying, productive work and take control of their family planning, history tells us this serves as a natural check on population growth, which also reduces emissions. And anybody familiar with Project Drawdown, where they have a number of scientists who have done exhaustive research about the things we can do to bring down emissions, they literally list helping women around the world with better health and better access to education is almost their #1 priority on a list of 100 things we can do. So moving on from there, I wanted to say that when we investigate the distinctions between ESG investing and low carbon, fossil fuel free investing is a different subset. ESG is a very, very broad umbrella. And here's the bad news. Many of the legacy fund families, the families I mentioned earlier, the Vanguards, the Fidelities, the American funds, et cetera, many of these fund families have launched funds branded as ESG or sustainable. BlackRock with their iShares is a perfect example of that still hold fossil fuel stocks. So that's really a dilemma. How do we know what a fund actually contains? It may have a brand name on it, it may be labeled or called something, but how do we know what it actually contains? And whether the companies it holds have good gender balance? The answer is we rely on our data partners, as you saw in Morningstar, and the tools they've created to help us lift the hood of a particular fund and see exactly what it contains. Next. So without further ado, I want to turn this now over to Andy Behar, CEO of As You Sow. He'll show you around their fabulous, unbelievably useful site. Andy, it's all yours.
Great, thank you. So I'm going to share a screen now. So I'm assuming everyone can see this is the Invest Your Values page on the As You Sow website. You can also get there through investyourvalues.org. Basically, what we created is a suite of tools that can look at mutual funds through different lenses, through fossil fuels, through gender, through weapons, deforestation, and we recently just added prisons. That's basically just about a month old now. So I'm going to give you a little tour, and I'm going to take you around and show you how to use it and kind of what it does. It's updated once a month. And what we do is, just for instance, you could type in Vanguard, and You can see many of the funds that Vanguard has. So let's just pick one. And it's going to break down, a mutual fund is a basket of stocks. So we're looking at every stock. Now, most of the time when you look at a prospectus for a stock, you only see the top 10 holdings. We're looking at, if it's the Russell 2000, we're looking at 2,000 stocks. If it's the Russell 3000, 3,000, the S&P 500, 500. So we look at every single stock, and so we break it down. So if you're looking under fossil fuels, you want to know who are the big oil companies. This is known as the Carbon Underground 200. It's the 100 largest oil companies, 100 largest coal companies by reserve. So we look at these. This list is updated once a quarter. And again, we update the holdings once a month. So this is always the freshest data. This is the coal industry. So you might say, okay, I have this Vanguard company, but what about all these coal companies? And then fossil-fired utilities. So we're looking at, actually, these are the companies, the biggest emissions. You know, a lot of people say, I want to get out of Exxon, Chevron. Those companies have reserves. So all of that carbon is underground. These are the folks who are actually burning it and bringing it to the surface. We also look at it in a different way. We look at it through the carbon footprint. So we add up the emissions of every company inside the fund, divide by the dollar amount. And this means 73 tons of carbon per $1 million US. So you can compare it, apples to apples, a $200 billion fund to a $2 billion fund, and against any benchmarks. We also look, we do a report once a year called the Clean 200. And some of the investments that were mentioned earlier on agriculture, on on companies that are really looking forward, we identified globally the 200 companies that are making the most revenue from clean and green energy. And so we also look at to see what's inside the fund on all these different aspects. So this is a way of breaking it all down. Now, if you're going to just stay with this one fund, you could say, well, what about deforestation? So we can look at this, and what you're going to see is it's all the companies in the fund that are in the business of producing palm oil, paper, rubber, timber, cattle, and soy. So reasons to burn down the Indonesian and the Amazon rainforest. And we work closely with Green Century, by the way, on the palm oil work. The banks and lenders who are funding all this work, and of course you'll see JP Morgan there, they are generally the worst of the worst. And then all the consumer brands. So a potato chip company that uses palm oil, if that's in your portfolio and you want to know, they get an F because they have so many of the producers. So just another, and you can also see, each of the companies, Archer Daniel Midlands, and what they do, and you could click here and you could get that. Now, another way you can look at this is by aggregating up for a fund family. So if you go over here and you look at the major fund families, for instance, Dimensional Fund, I can tell you does not really think that much about this, as you can see by, these are their top funds by size, but they obviously do not care that much about this particular issue. So another way of looking at these issues, just going to show you a few more, and is by looking at weapons. So people might want to know, do I have cluster munitions? Do I have landmines? Do I have nukes? Do I have major military contractors in my portfolio? So here's all the major military contractors in this particular portfolio. You can also, if you're interested in assault weapons and handguns and that sort of thing. So here's the gun. These are all the gun manufacturers, Smith & Wesson, Olin. And so you can see which companies, and also retailers. So we get into a lot of detail, and the data sets are all provided. We have relationships with 14 different data providers. Prison industrial complex is new for us, and we just did it. We work with the Quakers, with the American Friends Services Committee. And what we're looking here is both at the private prison industry, but also at border security and ICE. So, and again, each one of these is a different methodology, and it's all, each one is explained on there's a how it works page for each one of these, as well as we have an export spreadsheet. So all the data is shared publicly. You can download it and you can run whatever queries you want on that, on that. So I'm going to now just go over to, let's look at some of the funds we've been talking about. So Pax Elevate, Oh wait, I shouldn't have started there with you on there. You guys didn't. You guys have a couple of. Let me start with the good stuff here. Sorry. So let's start with gender equality. So the PAX Elevate Fund is simply the highest scoring fund. It's got a 98.3. It gets an A. It really is a leader. We just, by the way, upgraded this site. You probably haven't seen it because it was just last week, where we went from 12 to 19 key performance indicators, and we added these, which are both commitment to empowerment and audit, as well as these, which are a living wage, gender pay gap. So all this data is coming from a group called Equileap. They're based in Amsterdam, and so there's a lot more data now. You can really get into a lot of granularity now on gender equality funds that you couldn't just a few weeks ago. Another way you can approach figuring out good investments is you can go to search funds, and you could say, show me financial performance, and then you could sort by, let's 3 or 5 or 10 years. Let's sort by 3-year financial performance. And then you could go and you could put in all of your criteria. So you could say, I only want diversified funds. I want a fossil fuel grade that's above a B. I want a deforestation grade, B or higher. I want gender, it's got to be an A. And you can see how fast it's resorting itself on the fly. And then you can look across at all the different, all the different issues. You can also pick any 4 funds, and you can do a side-by-side comparison of them, where you can see everything about them, including, it gets really interesting when you start looking at the financial returns. And so, for instance, you could compare an S&P 500 index versus S&P 500 index without oil, and always it without the oil is going to be outperforming. So another let's see, another area that I can show you. The other, so just a note that as you sow, so we built all these sites, we maintain all these sites, and but it's really, that's only about 5% of our work. Most of our work is filing shareholder resolutions, and so it's and we work again with with our partners at both at PAX and at Green Century, and we work on a lot of different issues. I'm just going to quickly show you. We have a resolution tracker. So this year we had 131 engagements with companies, and we and on various issues. So on let me see, this is, yeah. So we did a lot of work on diversity and gender equality work. We do a lot of work on climate change, and we also work on the General Mills. So we work on regenerative agriculture, and we recently got Kellogg's to agree to stop using spraying pre-harvest glyphosate on products. So I'm going to pause here because I know we want to save a lot of time for questions, but all these tools are available. They're free. They're they're open to the public, and you can really get an idea of exactly how do you align your investing with your values, and if you know what you own first. So that is the intent of these tools.
Wow, Andy. Every time I get a new tour of As You Sow, I'm just overwhelmed by how much data you guys have collected and how well it's organized. So this is just an incredible resource for all of us.
Thank you. And also just a note, the end of the month, we're going to be coming out with workplace diversity, a data visualization tool that will allow you to look at the S&P 250. We will be doing the S&P 500. And we also have started a new initiative on racial justice, where we're analyzing the Russell 1000 on racial justice. So those scorecards will be coming out, and we are going to be engaging companies on, well, we've been doing diversity pretty intensely for the last couple of years, but racial justice will be filing the first resolutions in about a month or so.
Oh, fabulous. Next, please. Folks, I'm just showing, this is our other data partner, Morningstar, and I know this is pretty hard to see. I just wanted you to understand that along with As You Sow, Morningstar has really done a great job of organizing data around the ESG sustainability matrix. They even talk about something specific called carbon risk, which in shorthand means what is sort of the level of danger or threat to a particular company as the world makes an ever more rapid transition to a low carbon economy. Next, please. So I guess I just have to say this again. The paranoia about sustainable investors making a so-called performance sacrifice has been utterly dispelled by numerous studies. And the only people that don't seem to be fully aware of this are some of the frontline people that you might bump into if you walk in the front door of a Morgan Stanley or one of these legacy financial firms that just don't seem to have gotten a clue yet. And maybe it's because the funds that they have created don't really adhere to the ESG matrix. So just, there's so many studies. I had to run this by my compliance department, and they had to look at these, cited studies. It's been proven over and over again. It's not controversial at all. Next. So despite branding new funds as ESG or sustainable, none of the big four legacy firms has offered a fossil fuel free large cap stock fund. It's amazing. And their largest funds tend to track indexes like the S&P 500, which of course contains oil and gas companies. One thing for sure this year, the less exposure investors have to fossil fuel stocks, the better their performance. So when you look at your account statement and you see those names, Vanguard, Fidelity, American Funds, iShares, I'm sorry, but know that unfortunately you are the ones making a performance sacrifice. And we'll help you correct that. Next. So in financial services, conflicts of interest are a huge problem, especially if the person advising you works for a firm with its own funds. Certified financial planners, I happen to be one, are the only ones in the entire industry who are required by the CFP Board of Standards to adhere to the fiduciary standard, the same standard that lawyers have to adhere to when they are representing you. We have to adhere by the same rules and regulations of disclosure, making sure that every recommendation we make puts your interests first. Next. So if you ever are curious, you might want to go to the CFP, Certified Financial Planner, cfp.net website. CFPs have a rigorous 6-step fiduciary planning process that we implement when we're helping people organize their investment strategy. And more than that, all the different things that come up. What is an IRA? When to move from an IRA to a Roth IRA? Trusts. We do all of that. That's what certified financial planners do. Next, please. Our website also explains the step-by-step process. You might visit our website. It's greenriverfinserv.com. You can Google us and find us pretty easily. This is just kind of the routine. We have the initial meeting, no cost, no obligation. We use a risk tolerance questionnaire. There's a link to that on our website and also in my email signature where you can just go through 5 or 6 questions so we can sort of get oriented around where you are in your life and what your goals are. So these are just kind of a normal process that we go through. Next, please. This is just a reality check. Investors feel great when their investment strategy is aligned with their personal values. Next. Just wanted to show the ESG lens, kind of the Venn diagram lens one more time. Again, what ESG means is that we scrutinize the fund families that we've just heard from. They scrutinize each one of the stocks they're considering for the effect on the environment, the social impact, and how they govern themselves. Next, please. It's always important to talk about reality. Now, here's a basic explanation of how we are compensated for designing and managing fund portfolios for clients. One mistake investors make, and we'll probably get some more questions about this right now. It wouldn't surprise me at all. Investors, and I think it's mainly because of the overdone PR by organizations like Vanguard, investors are way too concerned about fund fees. This makes sense. I'm talking about the internal fund fees. This really only makes sense if you are comparing 2 identical index tracking funds. When we look at performance on behalf of our clients, we look at the net return after fees have been deducted. And a long time ago, laws and rules were passed in the financial services industry that prohibit fund families from even putting out their performance without first subtracting out the fees. So why would anyone prefer a fund with the lowest fees if a fund with higher fees has better net performance and a lower carbon footprint? It's irrational. The analogy I like to use is that is a person who is stepping over dollars to pick up pennies. And believe me, my final point here is the other side of this is what it costs to actually have a certified financial planner manage your account. If you don't think hiring a CFP is worth 1% per year, you're not being honest about your own investment experience. I see you. Next. Here's our contact info. That's our website address, phone number, email address. So feel free to call or email us to set an initial no cost, no obligation consultation. We're very nice people. We joke around, everything's relaxed and mellow. Don't wait, the time is now. Now I think we have time for some Q&A. I'll turn it back over to Natasha and Susan. Thank you, folks. Susan, I think you're muted.
Thank you so much, Patrick, Aaron, Andy, and Emily. That was fascinating. And I would really like to pick up a little bit further on the difference between investing in a fund with a great lens and investing in a stock directly. I was really taken by Aaron's explanation of we have advocates that when you pool your money with us, we are just out there advocating for some of those policy changes. So could you really articulate again what you see as all the advantages to investing in a fund with a lens that you care passionately about, as opposed to just, oh, this company is doing a good job and this company is doing a good job?
Aaron, do you want to address that?
I think you might have a more objective opinion since I'm on the fund side, Patrick.
Well, that's true. Well, there's a slide back in the PowerPoint where I listed the advantages, but managing client portfolios, I actually have received assets from people who had what are called separately managed accounts. That's kind of a private mutual fund where the investor actually owns each individual stock in this basket. And if you try to make changes to that portfolio, it's really cumbersome. I really like the agility of being able to buy or sell a fund. And by making one transaction, you are either gaining access to 50, 75, or 100 stocks, or you're exiting a position with all of those stocks. So that's one factor. The other is funds have professional management. They have a team. I mean, Erin has a whole team behind her. Emily has a whole team behind her. It really does take a team of people with a lot of analytical power to do the really careful decision-making around not only is a company a good company, maybe it has had a great run with its price appreciation, but the challenging thing for investors is when do you buy a good company? I mean, when do you buy Tesla? Do you buy Tesla when it's been on this amazing roll? Or do you wait until maybe some bad news comes out for a few minutes, maybe some short sellers are trying to attack Elon and the price goes down? So the fund managers, they take care of all of that. So those are just two of the main reasons. But I've always been a fund person, and I would rather have the individual stock selection process turned over to professional fund managers.
What you do give up is the ability to engage the company and to vote your proxies. I mean, those are really the two things that you do. And people who do own individual stocks. So as you said, as a nonprofit, I didn't really state that, but we're a 501c3. We don't own any stock. We actually are issue experts that people who do own equities, they ask us to represent them. They sign an authorization and they authorize us to file on their behalf. So those 70 shareholder resolutions we filed last year, each one of those had a person who owned stock behind it, who was the stock owner. They had us represent them. We filed the resolution. We engaged the company. We took it through the SEC. We did all the media, went to the annual meeting, et cetera. We did all of that, all of that work. And so just be aware, if you do own companies, you can engage, and we don't charge anything. We need the stock in order to do our advocacy. So it's just another opportunity to actually become an active investor.
Fantastic.
Natasha, I do see other questions coming in, and I know we're running out of time, so I'll let you take it from here.
All right, thank you, Susan. Yes, let's go to the next question. I see this is directed for Aaron, Green Century, and it's asking about F weapons rating according to fossilfreefunds.org, and just speaking to the war machine as an environmentally destructive fossil fuel industry.
Sure. So we partner with As You Sow, and these are fantastic tools for investors to kind of dig deeper on. And this is where the devil really is in the details. So for each of our funds, each of them has one holding that's less than 1% of the total value of the company. So for the Balance Fund and Equity Fund, if you click on that red highlighted area, it's Ball Corporation, which you might know from the kind of canning and the mugs that some of the hipster restaurants use these days. And Fujitsu is the company that's highlighted for our international fund, and they're a computing artificial intelligence company. And so the portfolio managers look at where are these companies categorized. There's this whole technical GICS, Global Industry Classification System, that puts a company in a certain category. So for the portfolio managers, these are not weapons companies. What they do, however, is service or have some contracts. So Ball Corporation has a laser division, and Fujitsu has these artificial intelligence and computing companies that have service agreements and contracts with military. So
I'm going to have to contradict you, because the reason that Ball Aerospace is on the Stockholm Conventional Arms list is because Ball Aerospace actually makes satellites that are involved with both missile guidance systems, and there's a reason that they're on the Stockholm list. So that's the list that we use. And by the way, last year HP was on the list. HP came off the list when they lost that contract to Microsoft. So it's not, they're not making canning jars. They are actually being used for tracking, and they're also satellite to satellite laser destruction systems. So just realize what you're getting involved with if you're going to buy. I know they look nice, the canning, but if you actually look, and go look on the website for Ball Aerospace, and you'll see what I'm talking about.
So again, this is a contract that these companies have for these services. So they're not making the military weapons themselves, which is the categorization that our portfolio managers
No, it's actually
use.
it's a subsidiary. It's a wholly owned subsidiary. But anyway, we can get into the details here. But Ball is something that a lot of people say, oh, they make jelly jars. Well, yeah, but they're also making. They also have other subsidiaries.
So again, it's less than 1% of the portfolio for each of them. So again, we would have a respectful difference of opinion of why the F grade is there and not a B or a C grade if you have less than 1%, which is the criteria for many of the screens. You want to have, a lot of the threshold is less than 5% or even 15% of that main line of business for that company. So, you can dig deeper, you can use these tools to find information, but for us, it's a starting point so you can understand what you're investing in.
And let me just weigh in for 1 millisecond. It's a little bit trite, but we have to remember not to let the perfect be the enemy of the good. And really what I'd help people do is, let's take a look at this fund and let's see, okay, maybe it does have an F or a D in one particular category, and let's bore down and see what that's all about, and we'll make a decision about whether that fund is right for the portfolio or not. Another thing I usually want to point out in this kind of a format is that first of all, diversification is a very, very important principle in building a portfolio, especially for people that need to earn a solid return. They're not philanthropists who can just invest money in ways that make them feel good. If you're not a philanthropist, you want to have a diversified portfolio, and your portfolio is not diverse if you don't hold some of the largest companies in the world. And you can pick any large company and there'll be something about it that you're not happy with. There's no question about it. So my professional opinion is you have to set up a hierarchy of concerns, And at Green River, our #1 priority is carbon emissions. So the first thing we emphasize is try to pick funds that don't have any fossil fuel exposure. And our second criterion is the gender lens piece. So, but other people may have a different order of priorities. So those are the things that we go through. That's the kind of the roll up your sleeves and start working this out that we get engaged with our clients.
Yeah, and I agree. I mean, I agree. You don't want the I mean, the tools that we do are really informational, but it also, we find that when fund managers see that they're getting this grade and it's just a tiny fraction of their portfolio, what we found is that they then reconsider and they go back and sell them, which is actually moving money away from these kind of companies. And so, and that's something that, you know, when we started fossil-free funds 5 years ago, there were only 10 funds that made the grade, that got an A. And now there's probably 600 of them. It's gone from about 1 billion in assets to over 400. So that's been a lot of fund managers talking to us and saying, why am I getting this? And they didn't even realize what their carbon footprints were. They didn't realize what they were in a lot of cases. So it's about total transparency and about people making choices that make sense for them. And I agree with, you know, Aaron, if it's a tiny fraction, my question is, why not get it out of the fund? But I do take your point that it's probably not that significant to an individual investor.
So here's a nice follow-up question to that. Do funds typically change their investment mix every month, or is it more often?
Well, I would say it really depends on the fund. I mean, when you see that a fund is quote unquote an index fund, they typically have very low turnover. There's almost sort of a mathematical description of the companies that they're going to own based on size and domicile. Then actively managed funds, and I have to say, I prefer actively managed funds for the most part. They're going to make changes to the portfolio based on opportunistic circumstances. I mean, you wake up in the morning and you see that, you know, Tesla is down 20%. Boom, that's a buying opportunity if you believe in that company. So that's the whole nature of investing for active managers. Is there, you don't do things on a set schedule like, okay, Friday I'm going to sell. No, it's based on what happens in the market. And that's one of the things that makes it fun for me, I have to say.
When the bottom fell out of the market recently, the COVID crash, the managed funds did much better because they were able to bail on all the cruise ship lines and the airlines and the oil companies really rapidly, whereas the indexes had to hold them. And so you saw literally a double-digit difference if you analyzed all of the managed funds versus all of the passive funds, because there was somebody at the helm. There was somebody actually making decisions. So it's you know, it's really a choice. It's also tend to be more fees, but post fees, you know, you got to calculate the whole thing out.
I'd add too that there's been a markedly outperformance of ESG actively managed strategies this year alone. I think we've kind of touched on these points, but you know, a big reason we invest our time and we add in this ESG criteria is we believe this is the way we want to invest, but we also do so for, you know, a long-term positive risk and reward. And we've really found that this year, a lot of the ESG issues we look at, it really, you know, is able to identify companies that are more resilient. And while we couldn't predict what we've gone through recently, companies that are forward thinking about things like climate, about things like their employee health and well-being, about diversity, that do tend to outperform. So I think that kind of ties it back to our overall reason that we invest in this way.
Could I ask a quick question about I think it was last year, the American Business Roundtable CEOs signed their pledge to be more mindful of all stakeholders, which certainly reflects a larger ESG lens. Have you actually seen real movement in most of those companies in response to that?
We filed resolutions with both BlackRock and McKesson on that issue, that we wanted to see their implementation plan, because we felt that they were saying one thing and doing another, that it was, you know, I mean, BlackRock tends to do that. They put out these great letters. They get, you know, Larry Fink gets an A+ for words and an F for action. What we're finding, and a lot of people say, oh, it was bullshit, it was greenwashing, but I take it very differently. I take this because the World Economic Forum actually followed up a few months later and declared a new manifesto, a fourth age of business. I mean, I take this as the indication that 50 years of shareholder advocacy has changed the very nature of business, and that the companies globally realize that stakeholder capitalism is a better path. That look at the world. I mean, this is Milton Friedman's idea that you can dump in the commons and abuse your employees and have slavery in supply chain has not played out well for the world. And so we find ourselves at this moment in time, an inflection point, and all the companies are now agreeing 100% with basically the As You Sow strategic plan. It's all about stakeholder everybody, all the shareholder advocates have been advocating for this for half a century, and now all the companies agree. So my take on it is we have not done enough as shareholders to incentivize the companies to fulfill what they have now materially obligated themselves to do. They have to do this now. They have made a material statement, and to not do so would be a breach. So we need to incentivize them. And when we move our money into companies that are leaders, General Mills on regenerative ag and Kellogg's on, there's companies that are making bold decisions. And when customers start to move their loyalty to those brands, that's when you're going to see a real shift to a whole regenerative economy based on justice and sustainability.
And I think just to add on that, do you want to go, Patrick?
No, go for it, Erin.
I was just going to share, the reason these companies are making these statements, because I think, as Emily mentioned, the consumer preference is there. They know what consumers want and what they want to hear. And now it's making sure that they follow up on this and holding their feet to the fire through these things. Like, we co-filed on that BlackRock resolution, and, just making sure that they don't get away with saying these, grandiose statements that sound wonderful, but don't actually follow through with their actions. So yeah, it's really important. And just, from a fund perspective, a lot of these funds, as Patrick mentioned, are talking about ESG, and kind of overnight they're rebranding some of these as, low carbon or carbon aware, or these different terms. If you look at the prospectus, that's the regulatory guidelines that the portfolio managers have to comply with in terms of what they invest in. And that's where you can see kind of the rubber meet the road. Do they have these screens in there, fossil fuel free, and any number of ones that you might be concerned about? So that's really where to look under the hood.
But even there, we sued Vanguard over having a fossil free fund with 26 fossil fuel companies, and we had to withdraw the case because the SEC allows you to misrepresent yourself in prospectuses. If you have a pharmaceutical free fund and it's 19% pharmaceutical companies, that's considered legal. There's a threshold. And so you can literally just utterly misrepresent yourself in the prospectus. And we brought the case and we lost, because that's just the way the SEC sees it. So just even looking at the prospectus, you still can't really tell. And I could show you 10 fossil free funds that are just chock full of fossil fuel companies.
It's true.
Crazy.
And again, so that's, everybody out there, you have to admit, Andy and his organization just provide us with these unbelievably essential tools to find out what we actually own or what we're thinking of owning. Susan and Natasha?
Great. Let me transition into the next question. We have time for, we have about maybe 4 or 5 minutes left. And this question is directed to Andy, and it relates to what we've been talking about. It's a bit longer, but I'll go ahead and read the whole thing so we can get some context. So it says, thanks for the great tool. Fossilfreefunds.org seems to be heavily focused on equity funds. Couldn't find many bond fund ratings. Are you expanding in the bond fund data set? Fossil fuel industry depends heavily on debt financing for their projects and keeping their dividends high. The stock market is relatively unimportant for the financial survival of fossil fuel companies if they can continue to get financing through loans or bond issues.
Purely a funding issue. We would love to look at all the bonds, but we can't afford the bond translator database. We get all of our data, it's coded in what are called ISINs. These are unique identifiers for each bond, each fund. And we're a nonprofit. We work on grants and individual donations. We literally just don't have the funding to license the bond, just like a Batman decoder ring. It'll translate the ISIN into, is this a muni? Is this a corporate bond, and which corporation? We have all the technology ready to set, we're all set up to do it, but we just haven't been able to raise that money. It's kind of hard for people to get their head around data licensing when there's so much going on in the world. So, we're ready to do it. We know how to do it. We've done an estimate, and I don't think that it would change the grade significantly. It's about 6%. But we only look at, so we're only looking at the equities, and we're only looking at mutual funds that have a 60% equity holding. So yeah, we would love to, believe me, we would love to actually even break down the municipal bonds too. There's a database we understand that shows municipal bonds that, it looks like you're funding a new roof for the library, but you're actually funding the local police department paying off families of police violence. So we want to get into all of that stuff. We're just love any new data.
So if there's any philanthropists out there that want to send some more money Andy's way, and not to toot my own horn too much, I can find emails right now that I sent to Andy over a year ago asking him about this corporate bond, the need for a corporate bond tool that does the same sort of scrutiny. And that one of the crazy things that the bond market is so untransparent compared to the equity market. It's just a different realm entirely.
Yeah, finding use of funds also within, if you get a Toyota bond, if it's being used to fund electric vehicles, very hard to tell. The use of funds goes into the general, it's very fungible. So,
right.
Needs work.
So on behalf of Marin Magazine and Make It Better Media Group, if you help us craft something that's the ask on your behalf, we'll include that in our better letters and see if you can get any help.
I will take you up on that.
Wonderful. All right, let's end with one more question. This is a general question, and it says, can funds claim they are fossil fuel free if companies lower their emissions by buying carbon credits?
Andy?
I can.
Oh, sorry. Go ahead, Erin.
I'll just touch on this. Our funds actually do follow our prospectus, and there is no common definition out there of what fossil fuel free means. So it really does help to dig into the details here. For us, we have a 3-part definition. So the first part is looking along the carbon supply chain. So no companies involved from the exploration, extraction, processing, refining, or transmission of coal, oil, or gas. The second is very nuanced language, no utilities that burn fossil fuels to generate electricity. And that's because we do have some geothermal and some water utilities in the portfolio on occasion. And then the last is no companies that own carbon reserves, which are the potential for future carbon emissions. So it is, helpful to just ask what these funds mean if they are saying fossil fuel free, like Andy's example before about finding ones that do own fossil fuel companies themselves. So that's really important.
After the Paris Climate Conference, we convened an international group to try to define these words. What is low carbon? What is fossil free? What is, et cetera? State Street had just come out with SPYX, which is the S&P 500 without, and they called it fossil free. And we objected. They actually changed the name because of our objections to fossil reserve free. Mm-hmm. So, and we tried to standardize it. We actually came up with definitions. We circulated it to the industry, but there's no enforcement. So they were not adopted. But I like green centuries. That was how we were defining fossil free, is basically in agreement with that, which is actually quite a thorough definition. So many people, they have a portfolio and they don't realize, this was when we were doing the divestment movement, all these people signed up, 60,000 people signed up, said, I want to divest. And they had no idea that they own these fossil fired utilities. All they were looking at was the Carbon Underground 200. So it's way more than reserves. It goes a lot deeper than that.
And let me just say one thing. Up until just recently, if you just walked in the front door of a regular, everyday financial organization, and you know, whether it be Morgan Stanley, any of these names, Goldman Sachs, whatever, they almost always, for American investors, they would say, well, the core of your portfolio needs to be an S&P 500 index tracking fund. And so when you folks out there listening, just take a look at your statements. If you have an S&P 500 tracking fund in your portfolio, and those are some of the biggest funds on the planet, 7 or 8% of that fund is funneled to the fossil fuel industry. So if I had one thing I want to remind people to do is get away from those S&P 500 tracking funds, get away from the Vanguard total stock index, et cetera, et cetera. There's alternatives. You're going to make more money if you have less exposure to fossil fuels. And that's all I have to say. I'm sticking with it, and I really appreciate everybody's input today.
Great. Thank you so much, Patrick. All right, guys. Well, that's all the time we have for today. Thank you so much for joining us. And you will expect to see a recording of this in your inbox tomorrow. So feel free to reach out to me in the meantime with any questions you might have. But thank you so much for joining.
Thank you all.
And any of these questions that didn't get answered, just let us know and we'll follow up with you. Thanks, everyone.
Thank you.
Thanks.
You.
Thank you.